Hey everyone, Fubo TV is an interesting company. It was one of the first companies to offer a sports-centric streaming app. So for those customers that didn't want the cable or satellite subscription, but they still wanted access to live sports, Fubo TV was one of the first options. However, their early advantage in being that sports-centric streaming app has dwindled away as more and more sports are becoming available across streaming apps worldwide. That's caused a lot of selling pressure on Fubo TV, and the stock is down over 90, 95, 98% off its highs. They recently reported financial results on August 6th, and I was interested to see their development and how they're addressing the situation given the rising competition from other streaming services that are adding more and more sports to their apps. So let's take a look at how this streaming app is doing. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So in their latest quarter, the company grew North American revenue by 26% and subscribers by 24%, which exceeded their forecasts. And this, furthermore, was the sixth consecutive quarter of year-over-year improvement in their global profitability metrics. Now, Fubo TV has been losing a lot of money on the bottom line, and these losses have continued for several years. But it's good to see the company making progress on profitability. I've highlighted that they need to raise prices much more so that they can better balance their cost versus revenue. They have done some price increases, but there's a lot more to do, and I'll share with you how much money they lost on the bottom line, and you can see for yourself how much price increases are needed to get the company on a more sustainable footing. Now, I talked about more and more streaming coming on streaming services, and one of those services is going to be a bundle with Disney, Fox, and Warner Brothers Discovery, and Fubo TV is not happy about that. In fact, they're going to the courts to try and settle this. In their last shareholder letter, they described an antitrust lawsuit against the anti-competitive practices by Disney, Fox, and Warner Brothers, which is harming Fubo industry competition and consumers. And I highlighted and I covered this lawsuit, and I said that regardless of the outcome of this lawsuit, more sports is coming online, more streaming services, and that's going to whittle away Fubo TV's market share. One of the reasons Fubo TV has been able to grow as it has is because other streaming services have been hesitant to bring sports on their streaming apps. One of those mentioned here is Disney. Disney has been hesitant to move ESPN completely to streaming, right? They've done it marginally. They do have ESPN Plus, which does have some sports, but it doesn't have the highest value sports yet, right? Some of the NBA content. You can't find that on ESPN Plus if you want to watch live NBA games. That being said, Disney is launching the ESPN app, ESPN proper, in late 2025, which is going to include all of the NBA content, all of that prime sports content, and that's going to hurt Fubo TV, no doubt, right? Consumers are going to have that choice now to go sports-only streaming, and many consumers are going to choose that, and some of those consumers that were subscribing to Fubo TV will leave Fubo TV and go to those streaming services that are offering sports without having to get a whole bundle like Fubo TV is offering. Fubo TV is not sports only, but it is sports centered. And the monthly price for Fubo TV approaches $70, $80, $90 depending on which services you add to the bundle. Whereas with the sports only apps, you're going to be able to get that for $40 a month or less. In the case of this bundle, Venue, their bundled pricing was around $40 per month, so about half the price of Fubo TV, and you're going to get a lot of sports in that app. So Fubo's prospects longer term are not great, and sure, they can launch some Hail Marys like this one with the lawsuit to try and stop or slow down these developments, but they're not going to be successful in holding this competitive position because companies are coming out and they're slowly transitioning more sports onto their streaming services, and that's not going to be good news for Fubo TV. So speaking of its net losses, in the latest quarter, they generated revenue of $391 million, and the net loss came in at $25.8 million. So losses have been improving. The same quarter last year, they lost $54.2 million on revenue of $312 million. So they are improving the losses on the bottom line. That is good news for Fubo TV stock investors. They also added a significant amount of subscribers in the latest quarter. They now have 1.45 million North American subscribers. That was down from the previous quarter, but that seasonal decline is expected because the second quarter is a slower quarter when looking at the sports schedule. So there is a sequential decline there, but that was up significantly from the second quarter the prior year, where they only had 1.167 million subscribers. The price increases are helping increase average revenue per user. It was up to $85.69 in the latest quarter. That was up from $81.62 in the same quarter the prior year. It looks like they're going to need significantly more subscriber price increases in order to become profitable. As you'll notice, with $85 of average revenue per user, they still lost $26 million on the bottom line in the latest quarter. Now, the company is forecasting significant growth in subscribers for the end of the year. They expect to reach 1.73 million subscribers by the end of the year. But they also noted that they're not including in their subscriber forecast the impact of the launch of that bundled sports streaming service, because they note that it could be very volatile and it's very uncertain, so they're not going to include that in their forecast. However, if that sports streaming service does launch and it goes without any sort of restriction from the lawsuit, then that's going to hurt Fubo TV, and I wouldn't be surprised if their full year guidance is revised lower if the outcome of that court case is not beneficial to Fubo TV. Now, one area I was very impressed with Fubo TV is in the improvement in the expenses as a percentage of revenue, most specifically the subscriber-related expenses, which is their largest line item in cost. You notice here the 84% that they highlight here in the second quarter of 2024, those are subscriber-related expenses. Fubo TV, the way they pay for content is on a subscriber-related basis. So if Fubo TV adds one more subscriber, they have to pay the content providers for that one more subscriber because they're showing that content to that new subscriber. So they have to pay the content providers for that new subscriber. And that's why Fubo TV has failed to gain much traction in terms of profitability. And that's why I've had Fubo TV rated as a sell for several years now, is because of this business model and how it doesn't leverage effectively. It's not like other content companies where they pay for content and then as revenue grows, their profits expand because they've already paid for content, and so they don't have to pay more for content when they get new subscribers. That's not the case with Fubo TV. When Fubo TV gets new subscribers, they have to pay more for content because that's how the arrangement is signed with the content providers. It's not a lucrative business model, and you've seen evidence of that over the years. Fubo TV's stock price has fallen from highs of over $60 per share. It's now trading at just $1.24 per share. And I've had Fubo TV stock, you can see here, rated as a sell. I last updated that recommendation on May 3rd, but I've had Fubo TV stock rated as a sell for roughly 3 years now. And so it's not new that I have the stock rated as a sell. And if you followed that recommendation, you would have saved a great deal of money on this stock. As I showed you the chart, it's now trading at just $1 per share, down from over 60. So you would have saved a lot of money if you had been watching these videos and my articles on Fubo TV stock. But nevertheless, this is a big improvement for Fubo TV. Subscriber-related expenses, only only 84%. That's still very, very high, but it's down from 90% in the previous quarter and down from 87% in the same quarter in 2023. So they're finally making some inroads in this line item, although still it's very large, and that's hard to be profitable on the bottom line when you have this kind of content arrangement. And there is no fundamental advantage for Fubo TV. It doesn't own the content, the vast majority of its content. It has to license from other providers, and it's sports. So it's not like a movie where you create this movie and it's on your platform forever and you can benefit from that several years into the future. That's not the case here. You pay for content this season. Next season, you've got to pay for content again and again and again and again. And those costs are rising and rising and rising. And Fubo TV doesn't have any negotiating advantage against the partners it's negotiating against. So its costs will continue to rise. For all of those reasons, I haven't liked Fubo TV stock. And even after these results, Fubo TV is now trading at a forward price to sales of 0.2. It's the cheapest it's been in a very long time. But I don't think it's a bargain. I don't think it's a buying opportunity. I think investors should continue to avoid Fubo TV stock. And I'm updating that recommendation again here today, rating the stock as a sell. Now, I hope this doesn't go against some of you folks that might own Fubo TV stock. I'm not trying to cause the stock price to fall. I have little influence over stock prices anyways, but I'm just trying to inform Fubo TV investors and those that are interested in Fubo TV stock that the underlying business model and the underlying business fundamentals are not attractive from an investor's viewpoint. There isn't a case to be made for Fubo TV in any way that makes it attractive for investors. There's a small probability that this business model becomes successful over the longer term. There is a pathway for success, but that pathway, in my opinion, is small. The probability is small for Fubo TV to thread that needle and get in there and make a success of this business model. So for that reason, I'm keeping the stock rated as a sell. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.